Welcome back to Intermediate Accounting. This video provides an introduction to accounting for bonds. Let's get started by taking some notes first about bonds, and then we get into the actual accounting for the bonds. Bonds represent a promise to pay a sum of money at a designated maturity date. Plus periodic interest at a specified interest rate. And that rate is applied to the maturity amount. Maturity amount or maturity value, also referred to as face value of a bond. So the full amount will be received by the issuing company on the maturity date, or paid out by the issuing company on the maturity date, plus the borrower will also pay periodic interest, a specified rate on that face value. Bonds are paper certificates, or at least electronically. When paper was actually sent out, now they would be considered electronic certificates, typically face value of $1,000 increments. Interest payments are usually made semi-annually or twice a year. And why are bonds issued? Typically, when the amount of capital that is needed, the amount of cash that a company needs, is too large for one lender or one bank to supply. So a company wants to raise a lot of cash. The bank says, no, we're not going to lend to you. That's too risky. What the company may decide to do, if it definitely wants to use debt to raise its cash, it might go out to either the public or the private bond market and say, we're issuing these $1,000 bonds, maybe an interest rate of 4 or 5%. And then any interested bondholders will go out and investors will go out and invest in these bonds in order to receive the periodic interest and of course their principal at maturity. Let's take a look at an example of a basic issuance of bonds. Buchanan Company issues at par 10-year term bonds with a par value of $800,000. Bond is dated January 1st, 2020. It bears interest at an annual rate of 10%, payable semi-annually on January 1st and July 1st of each year. It records the following entry. So journal entry on the date of issue, January 1st, the company is going to receive cash. The bonds were issued with a par value of 800,000. They were issued at par. So the company receives 800,000. And of course, now they have to repay $800,000 the end of the 10 years. So we record an increase to the long-term liability, bonds payable for 800,000. Next, 6 months goes by and the first semi-annual interest payment is made to the bondholders, the investors. The company needs to record in the journal entry, which is going to increase interest expense for the amount of the par value of the bond or face value of the bond, 800,000, multiplied by the stated rate, interest rate on that bond, 800,000 times 10. And these payments are made semi-annually. So this bond payment would be for 400,000. And so again, the 400,000 is the par value or face value of the bond times the stated interest rate, also called the coupon rate of 10%. And if these bonds were paid interest annually, that would be it. It would be $80,000 per year, but their interest rate is semi-annual. The interest is paid semi-annually. So we need, this rate is based on an annual or 12 months. They're paid twice a year, so every 6 out of the 12 months. So 6 out of 12, 80,000 divided by 2 gives us interest expense of 40,000. And the interest is actually paid out on July 1st, so the company is going to credit cash for the 40,000. The next journal entry that'll take place, or the next transaction related to the bonds, is its year end, and payment is going to be made, remember, based on the terms of the bond, payment is going to be made on January 1st. So on December 31st, 2020, we know tomorrow, the very next day, we're going to make payment. But what's important about December 31st, we're putting together the financial statements, the balance sheet and the income statement. If we do nothing else, we're forgetting the fact that the company has borrowed money and there's a cost to borrowed money, interest expense. So an adjusting entry needs to be recorded at December 31st. To record the interest expense that's been accrued since July 1st through December 31st, so an additional 40,000. It will be paid tomorrow, so on the financial statement date, December 31st, we need to record the fact that we owe $40,000. Now, if the bond had made payment, if the bond terms were to make payment on December 31st of this year, of course, this would not be an adjusting entry. This would be an entry for the cash payment. So the debit portion would look the same, but the credit would be a credit to cash. Now, what happens when companies issue bonds between interest dates? Well, this is what the accounting rules say. When companies issue bonds on any date other than the interest payments dates, the interest accrued from the last payment date to the date of the issuance of the bond is paid by the buyer to the seller or issuer. So the buyer of the bond, the investor, the bondholder, prepays the interest that they missed. And then on the next semi-annual interest payment date, the full 6 months interest payment is received by, of course, the buyer of the bonds. Call this the bondholder, the purchaser, or the investor. Let's take a look at an example. On March 1st, 2020, Taft Corporation issues 10-year bonds dated January 1st, 2020, with a par value of $800,000. These bonds have an annual interest rate of 6%, payable semi-annually on January 1st and July 1st. Taft records the bond issue at par, $800,000, plus the accrued interest. So on March 1st, Taft is going to record an increase in cash. It receives not only the full $800,000 of the face value of the bonds, but also the interest that has been accrued so far. So we have 808,000. Let's look at the other sides of the entry to see where we get the 808,000. Of course, we record an increase to the liability account, bonds payable, for 800,000. And now the other side of this entry is going to be a credit to interest expense. So that should look strange. We don't typically credit interest expense. We typically debit, but we actually have a reduction of interest expense in the amount of 8,000. And this 8,000 is calculated as par value of the bond, 800,000, times the rate on the bond, the stated rate of 6%, and then the amount of time that has passed since the last interest date. So the bonds pay interest semi-annually on January 1st and July 1st. They pay interest on January 1st, but they're being issued on March 1st. So we're accounting for the time that has passed between January 1st and March 1st. So 3 out of January and February, 2 out of 12 months. So 48,000 times 1/6 equals 8,000. So that's how we get the total cash, 808,000. On July 1st, at the next interest payment date, 4 months after the date of the purchase, Taft pays the purchaser the full 6 months interest. So now Taft makes its typical debit to interest expense entry for 24,000. Let's see where this 24,000 comes from. We're going to take the par value of 800,000 multiplied by the interest rate of 6%. And this is a semi-annual interest paying bond. So 6 out of 12 months. That's how we get the 24,000 interest expense. And the credit, of course, is going to be to cash because Taft is paying out the full amount of cash to the bondholders. That concludes the accounting for at the very basic level for bonds. Future videos will look at bonds that are issued when not at par value.